Financial stocks are leading the market. That one sentence moves billions of dollars, and most people have no idea why. The question worth asking isn't whether banks are rallying, it's what mechanism is actually pulling that money, and whether it holds when the Fed finally moves. Financial stocks have been among the market's strongest performers in recent weeks. Investors are rotating into them, pulling money away from other sectors and placing it inside banks, insurers, and other financial firms. And the reason analysts keep circling back to the same thing: the Federal Reserve's next interest rate decision. One way or another, that decision is expected to shape how far this rotation can run. The rotation itself is the news, but the mechanism underneath it is decades old, and it plays out every single rate cycle. Understanding it tells you something far more durable than any single week's performance. Let's be precise about what a sector rotation actually is. It's not a mass panic. It's not a crash. It's a deliberate, gradual shift. Large pools of money moving out of one part of the market and into another, based on changing expectations about the future. Investors aren't reacting to what has already happened. They're pricing in what they think is coming next. That distinction matters enormously. Markets move on anticipation, not confirmation. By the time a central bank actually announces a rate decision, the money has often already moved. The investors who understood the mechanism early got there first. The ones who waited for the headline often arrived late. Financial stocks, banks especially, sit at the center of this because their core business is almost uniquely sensitive to where interest rates are heading. A bank borrows money at one rate and lends it at a higher rate. The gap between those two rates is where profit lives. When that gap is expected to widen, banks become more attractive. When it's expected to narrow, they become less so. It's that direct. And because rate expectations shift constantly, financial stocks tend to move before the rate itself does. Here's the analogy that makes this click. Think about a baker who buys flour in bulk every morning and sells bread throughout the day. If the price of flour is expected to fall, the baker's margin, the gap between cost and sale price, gets wider. The baker becomes more profitable without selling a single extra loaf. Now imagine thousands of investors watching that baker's cost structure every day, adjusting how much they'll pay for a share of the bakery based on what they think flour will do next week. That's essentially what happens with banks and interest rates. The flour is the cost of short-term money, what a bank pays to borrow. The bread price is what it charges on loans and mortgages. The gap between them is called the net interest margin, which simply means profit on lending. When investors expect the Fed to hold rates higher for longer, they expect that lending margin to stay wide or even widen further. Banks earn more on every loan, so money rotates in. When investors expect rate cuts to come quickly, the math runs the other way. The margin compresses, and money tends to rotate out. This is why you'll often see financial stocks move sharply, not when a rate changes, but when the language around future rate decisions shifts. A single phrase in a central bank statement, even a subtle one, can reprice the entire sector in an afternoon. The mechanism isn't about the decision itself, it's about the expectation of the decision. And expectations are always moving, always being revised, always pulling capital toward wherever the next advantage appears to be forming. So what does any of this actually touch in the real world? Start with mortgages. When banks are expected to remain profitable at higher rates, they have less urgency to compete aggressively on lending. Mortgage rates tend to stay elevated. The family looking to buy a house feels that directly, in the monthly payment, in the amount they can afford to borrow, in whether the purchase pencils out at all. Now flip it. If investors start rotating out of financial stocks because they expect rate cuts soon, that's a signal that lending margins are expected to compress. Banks may compete harder for borrowers. Mortgage rates can begin to drift lower. That same family suddenly finds the numbers look different. This is the part that gets lost in financial coverage. The rotation showing up on a screen in a trading room eventually shows up on a kitchen table in the form of a mortgage statement or a small business loan offer. Insurance companies feel it too. They hold enormous reserves of bonds and fixed-income assets. When rates are high, those reserves earn more. When rates fall, they earn less. So an insurer's profitability is quietly tied to the same expectations driving the bank rotation. Even the credit card rate you pay on a balance is downstream of this mechanism. Banks set those rates partly based on their own cost of funding. When that cost is expected to stay high, they have less room, or less reason, to lower what they charge borrowers. The rotation you see on a financial channel is not abstract. It ends at your wallet. So here's the answer to the question this opened with. What is the mechanism actually pulling money into financial stocks, and does it hold when the Fed moves? The mechanism is margin anticipation. Investors are buying the expectation that the gap between what banks pay to borrow and what they charge to lend will stay wide or get wider. They're not buying last quarter's earnings. They're buying a forecast of future profitability baked into the rate environment. Whether that holds when the Fed actually moves depends entirely on whether the decision matches what was already priced in. If the Fed holds rates and investors expect it to hold, the rotation may continue steadily because the thesis remains intact. If the Fed cuts more aggressively than expected, margins compress faster than modeled, and the rotation can reverse sharply, even if the cut itself sounds like good news. If the Fed signals it will hold higher for longer, financial stocks often get another leg of support because the wide margin environment extends further into the future. This is the core irony of financial markets. Good news for the economy. Rate cuts, easier borrowing, can be bad news for bank stocks in the short run because it squeezes the very margin that made them attractive. And the reverse is equally true. The rotation into financials isn't a bet on a strong economy. It's a bet on a specific interest rate environment. When that environment changes, or even when expectations about it change, the money moves again. That's not a flaw in the system. That's the system working exactly as designed. Every rate cycle runs this rotation. The sector, the names, the timing shift. The mechanism doesn't. If this breakdown changed how you see the connection between central bank decisions and your own financial life, share it with someone who's watching the market without understanding what's actually moving it. And if you want to understand the other mechanisms that quietly shape where money flows, subscribe. We cover them without the noise.